Ready to understand the forces shaping your wealth? We demystify global markets, complex economics, and investment strategies. Your financial knowledge is your power. Welcome, friends, to Markets and Economics. Welcome, sir. Today we discuss about futures and options, or F&O, are discussed everywhere, often promising huge gains. But we know they carry high risk. Can you first explain, in the simplest terms, what F&O actually are?
Absolutely. The most important thing to know is that FO are derivatives. This means their value is derived from something else, something called the underlying asset. This asset could be a share of Reliance or a stock index like the Nifty. You are not buying the share itself. You are buying a contract that tracks its price.
Okay, so what is the core difference between the two, a future and an option?
The difference lies in the commitment. A futures contract is a mandatory obligation. If you enter into a futures contract, you are legally obligated to buy or sell the underlying asset on a fixed future date at a fixed price. An options contract, however, gives the buyer the right, but not the obligation, to buy or sell. Analogy: think of a future as a marriage contract. You are fully committed. An option is like buying car insurance. You pay a small fee for the right to claim if something bad happens, but you don't have to use it.
Let's stick with options for a moment. I hear about call and put options. What do they do?
Simple. There are two types. 1. Call option gives you the right to buy the asset. You buy a call if you expect the price to go up. 2. Put option gives you the right to sell the asset. You buy a put if you expect the price to go down.
What about the price? What are strike price and premium?
The strike price is the fixed price at which the transaction would happen if you choose to exercise the option. The premium is the price you pay upfront to buy the option. As an option buyer, the premium is the maximum amount you can lose.
And lot size. Why is that so important?
FO contracts are traded in standardized quantities called the lot size. Example, 50 shares. This is the source of leverage. A small move in the underlying asset's price is instantly multiplied by the lot size, making a tiny profit or loss per share into a big profit or loss in your account.
All FO contracts have an expiry date. How does time affect the contract?
Time is the option buyer's biggest enemy. This is called time decay, or theta. Theta measures how much an option's value is expected to decrease every day just because time is passing. Time decay accelerates significantly as the expiration date gets closer, especially in the last 45 days. As a buyer, you need the market to move fast to beat this constant loss of value.
How do we gauge the market's expectation for movement? That sounds like what implied volatility, or IV, is about.
Exactly. Implied volatility is the market's collective forecast of how much the price will fluctuate in the future. Implied volatility analogy. Think of implied volatility as the weather forecast for the market. High implied volatility means storms are expected. Options are expensive because premiums are high. Low implied volatility means calm weather. Options are cheap. Smart traders use this to decide if they should buy expensive options or sell cheap ones.
How do we track what the big market players are doing? I believe open interest is key here.
Open interest, or OI, is the total number of options or futures contracts that are currently active or unsettled. It shows where the capital is committed. When you combine open interest changes with price changes, you get 4 simple scenarios to confirm a trend. 1. Price rising plus OI rising. Strong bullish confirmation. New buyers are entering. 2. Price falling plus OI rising. Strong bearish confirmation. New sellers are entering. If price is rising but OI is falling, this is known as short covering. This means existing short sellers are panicking and closing their positions, which temporarily pushes the price up. But since no new capital is entering, the trend is weak and less sustainable. And if price and OI are both falling, that is long unwinding. This means existing buyers are closing their profitable or losing positions, causing the price to fall. This is also a weak move, often indicating profit-taking, rather than fresh bearish conviction.
That is a perfect clarification. So, we should look for rising OI to confirm the strength of any price movement. Now for the most important part. Why is F&O trading so dangerous for the ordinary trader compared to simply buying a share?
It comes down to two irreversible risks. First, leverage and margin calls. Because of the lot size, your positions are highly leveraged. A small market move against you can result in losses higher than your initial margin. If your losses mount, your broker will issue a margin call, demanding immediate additional capital. If you cannot pay, your position is force closed at a loss. Second, and this is critical for Indian stock derivatives, the physical settlement trap. SEBI regulations mandate that stock futures and in-the-money (ITM) stock options must be settled by physical delivery of shares upon expiry. This means if you hold a profitable stock option till the end, you must either receive or deliver the actual underlying shares. If you don't have the massive funds to buy the lot, or the shares to sell, you face severe, punitive auction penalties and financial ruin. Critical warning. As an ordinary trader, you must close all ITM stock FO positions well before the final expiry date to avoid this massive operational risk.
And what about our own behavior? Are there psychological risks?
Absolutely. The high leverage amplifies human mistakes. The most common is loss aversion, the refusal to cut a losing trade. People hold on, hoping for recovery, but the leverage and time decay turn a manageable loss into an account-destroying drain.
If the risk is so high, what is the rational, sustainable way to use FO?
The original purpose of FO is hedging, using it as insurance to reduce risk on existing investments. For example, if you own 1,000 shares of a company and you worry about a short-term correction, you can simply buy a put option on those shares. If the market falls, your put option gains value, offsetting the temporary loss on your shares. You protect your portfolio without selling your long-term holdings.
Finally, what are the non-negotiable rules for any new trader entering this space?
You need systematic defense. Rule number 1 is position sizing. You must calculate how many contracts to buy, so that you never risk more than 1% or 2% of your total trading capital on any single trade. This is the ultimate safeguard against losing everything. Rule number 2. Use stop losses. Implement a mandatory stop loss order to automatically close a position if it moves against you. In FOO, letting losses grow will liquidate your account. Rule number 3. Trade with a plan, not emotion. Define your entry, exit, and stop loss before you enter the trade, and stick to it religiously. Discipline is your only survival tool in this highly leveraged market.
That's excellent, practical advice. Thank you for making these complex concepts and, crucially, the serious risks so clear for the ordinary trader. We covered the core risks and definitions, futures, options, and the physical settlement trap. Sir, that was a foundational lesson on what F&O is and the difference between the obligation of a future and the right of an option. Thank you.
My pleasure. Understanding those basics, futures, options, premium, and strike price, is the essential first step before anyone enters this market.
And thank you, our viewers, for watching part 1 of our definitive guide. In part 2, we move into the critical mechanics and the major risks. We will show you how to calculate your break-even point, expose the option buyer's greatest enemy, time decay or theta, and reveal the ultimate threat, the physical settlement trap. Plus, we will show you how to use advanced metrics like open interest, or OI, and IV, percentile, to time your trades like a professional. You simply cannot afford to miss it. So, if you found this segment helpful, please hit the like button. Subscribe to our channel and click the bell icon so you get the notification the moment part 2 is released. Share this video with a friend who trades F&O and leave a comment below telling us which topic you are most excited about. Goodbye, and we will see you in part 2.